Hi, Dominique, and welcome to another edition of the week ahead. How are you doing?
Fine, thank you, Andrew. It's good to see you.
See you as well. Um, and I would say for the first weekend, certainly in London, it's pretty hot. It's about 26, 27 degrees and very nice, sunny. So we're all
Lucky you. We are still
enjoying
under the dome in California with very
that.
thick, low gray clouds. Can't see a thing.
Right. Oh, no. Um, okay, as we always like to do, let's kind of dive into this previous week. What things stood out for you from the politics, from the central bank policy, market reaction and data?
So, without doubt, the most important event of the week was the Treasury revising down its target from the end June TGA to 425 billion from initially 450 billion. Let me explain why this is important. It's because following the debt ceiling agreement, the Treasury is on an issuance spree to rebuild its cash buffers and also to plainly fund the government deficits. And so there was a lot of fear in the streets about this wall of issuance, and in particular about the liquidity drain that would have been caused by the Treasury. This was a May 1st announcement, the quarterly refunding announcement, that they were going to rebuild the TGA over 4 weeks to 550 billion. So by the end of the month, from nearly zero. I mean, with the debt ceiling standoff, the cash balance of the government went down to 20 billion, not too far from where I had predicted. It didn't quite happen the way I thought, but it got close. So, uh, but in terms of TGA, this was an enormous increase over a very short period of time. And on top of that, in terms of cutting down liquidity, the Treasury TGA buildup was going to drain liquidity by about 500 billion over 4 weeks. Plus, you had the Fed that was going to uh, decrease assets by another 100 billion. So altogether, based on the Treasury initial plans, you would have had a drain of 600 billion, a liquidity drain of 600 billion. And I think most of it would actually, two-thirds of it would come from reserves rather than the TGA, or certainly initially. So I think the market had reasons to be worried. On the other hand,
Yeah,
neither the
because a few
Treasury,
banks were calling for like a significant sell-off in equities because of
exactly,
this. Yeah,
exactly. But the thing is, neither the Treasury nor the Fed are going to deliberately crash money markets or crash financial markets. So to me, this announcement didn't make sense. It was too much over too short a period of time. And the fact that it was brought down to 425 billion shows that this view is correct. I mean, the buildup of the TGA will happen, but over a longer period of time
right,
and in a gradual manner so as not to crash
right. Which
markets.
is exactly what you were predicting.
So
So
this
I guess
was
that combined with some market participants um, preparing for this probably caught, maybe that's why equities rallied so much that a lot of them.
exactly, exactly. So I think it seems to me that this is out of the way in terms of, clouds on the horizon. Uh, Now we are coming into Fed week, and I fear I'm hoping it's a little bit boring. Um, I see not much scope for surprise, if anything, a dovish surprise, because we already know that the Fed is going to so-called skip the June meeting, so there is no hike. And at the same time, it seems to me that there is a bit of scope for surprise on the dovish side First of all, because the Fed reaction function has turned dovish. I'm not sure people have put up on it, but you've had a dove appointed to vice chair, so from governor. So that's Governor Jefferson. So an increase in the influence of the doves. And then you had New York Fed President Williams telling us that actually the uh, natural rate of interest has not changed relative to the before the pandemic. We are still in the era of very low interest rate. His estimate of R star is 0.5%. If you look at the five-year tips, for instance, it's about 1.4%. So you take out a little bit for the term premium because the R star estimate of President William is very short, short term. Let's take 40 basis points for term premium. That leaves us with a long-term real rate well above the estimate, Williams' estimates of the natural rates, which implies that monetary policy is very tight.
Right.
I personally disagree, but it doesn't matter what I think. It's the Fed, taking the shots, not me. And so this new estimate, which has been 3 years in the making, ever since Williams joined the New York Fed, he stopped running estimates of R star until recently. So this is something he's been thinking about a lot. Is another reason why the Fed is turning dovish. And so I think the surprise could very well be that there is no increase in the median 2023 dots. Especially if you look at the distribution of dots in March, you had basically 11 dots at 5.1% or below. Believe it or not, there is one FOMC member who thinks they will cut in 2023. I have my ideas on who that might be, but no names. And so, and 6, 7, and so 11 at 5.1 and below, and 6 or 7 above, which are the hawks. So the doves, I think, have not changed.
But where was Williams before? I thought he was more
Williams,
on
I think, was Williams, I think, was with a 5.1% crowd.
Okay.
So I think what's going to happen is that the hawks. So Williams, I think, was with the 5.1 crowd. So what's going to happen is that the hawks, we're talking about Bowman, Waller, the hawks are going to raise their dots. Okay. And this will change the mean, but it will not change the median because you would need 2 doves to move up to change the median. And on balance, I think they are more likely to stick to their guns.
Okay. So the median won't change. So that's going to be the important thing. Okay.
So that could be a surprise. And in general, the dovishness could surprise simply because I don't think the market has caught on the dovish term of the FOMC. The bottom line is we've had very strong data since the last FOMC meeting. And yet the Fed is going to skip a hike in June, even though core inflation or all the measures are inflation that the Fed cares about, like hypercore, for instance, they are well above. The Fed told us at the last meeting that they were not necessarily done with hiking. It depended on the data. If you look at the data since then, it shows strong inflation, strong growth, and yet the Fed has decided to skip the June hike, even though inflation is well above the target and is not slowing down.
Right. Trying to think what else kind of stands out. So, and how do you think the market will take this? The front end, I guess the front end won't move. You think there'll be somewhat of a curve steepening?
Definitely. I also think that the equity market will love it because inflation is stable, growth is, if anything, accelerating. The Fed is pulling in its horns. So, basically from an equity
Positive
perspective,
equities.
yeah,
Right.
it's very positive and
Positive
definitely
equity,
curve steepening.
positive EMFX, maybe
Very
positive
much so.
commodities. Okay. Okay, cool. Let's dive into a bit deeper outside of the Fed meeting next week. Obviously, that's going to be the dominant thing. Anything else that our clients, investors should be thinking about?
Quite a bit of data. I mean, the CPI, and I expect the CPI to show the same pattern that we have seen in terms of the median price CPI, which is my preferred measure of inflation trend, will still be around 7%. In terms of the Fed hypercore, so core services without housing, not much of a change either. If anything, a slight move up. So no surprise there, but the Fed doesn't. Anyway, the data is coming on the first day of the Fed meeting, so it will have no influence on the outcome. And the Fed seem to be quite oblivious to inflation risk. So we have that. Then we will have PPI and import prices, and the consensus doesn't see much of a change. In any event, for the Fed, what matters is services, not goods inflation. So it doesn't matter that much. Then we will have uh, retail sales. And again, the consensus is something somewhat of a slowdown, uh, 0.3%, excluding auto and gas from 0.6% last month. But let's remember that we're still in a period where households are cutting down on the excesses of the pandemic. So, for instance, on spending on food and alcohol, believe it or not, that had gone up a lot. So all those things are moving back to trend. We've had a string of data with weak retail sales followed by stronger personal spending, which is a more comprehensive uh, release, and I expect that to continue. We also have some survey data, the Philly Fed, the New York Fed, manufacturing survey. We have IP. I mean, I pay more attention than IP, more attention to IP than to the surveys because
Right.
we know what the survey data is. It's basically an opinion poll with the Republican being very negative and the Democrat being very positive. I'm simplifying here, but it's clear that survey data is much less reliable than it used to be. So the hard data, the IP is not going to be great, but since manufacturing is only 10% of the economy, not a cause for alarm. So maybe the more interesting data point besides the CPI could be the University of Michigan consumer confidence. And in that data point, the inflation expectation, long-term inflation expectations are creeping up. They are now at the level of the mid 1990s. Now, the Fed contention ever since you've had this huge increase in inflation has been, it doesn't matter because inflation expectations are stable. I personally think that it's the wrong way to look at this. I think it's not an issue of whether they are stable or not, but whether they are high or low. High being the level where they start changing behaviors. And I think we are already there. But again, I'm not making the decision. It's the Fed.
Right.
And the Fed is going to have, when you have the Michigan expectations going up steadily, it's going to be more and more difficult for the Fed to claim that inflation expectations are well anchored. And that's, by the way, one of the reasons why I'm expecting probably a couple more hikes between now and the end of the year based on current inflation trends, which are basically inflation is high, is not coming down, but it's not going up either.
So that'll be like September, October then.
We could do, I mean, July is possible, July or September, and then another one, simply because inflation is not going to be a core PCE is very unlikely to be at 3.6% by the end of
Right.
the year, as the Fed is telling us.
Right. So you still like somehow kind of paying rates in the very short end. Yeah. And we've
Yeah,
talked about this many times. Yeah.
oh yeah, there is no way the Fed is going to cut rate. I mean,
Yeah.
short of a meteorite landing in the middle of the US and creating a macroeconomic catastrophe, I can't see
Yeah.
the Fed cutting down rates this year.
Right. And then on just the last, I guess, banking stress, is that just completely behind us, or do you still see, and like, are higher rates still something that will hit small, medium-sized banks, or higher rates will give these small, medium-sized banks an opportunity to put out loans at quite high rates and grab that carry?
So higher rates, I mean, that's the thing that surprises me. People have said that a steeper curve is better for banks. In reality, if you look at interest margins, there is no relationship with the shape of the curve, but that's another story. To reply to your question, I think the banking crisis is a slowly simmering crisis on the back burner. It's clear that by now the Fed has managed to stabilize the situation. It's clear also if you look at the data, bank loans have been flat for the past 2 to 3 quarters. We are at the stage in the business cycle where growth is not dependent on credit because households and businesses are repaying their loans. So I don't see at the moment the banking crisis impacting the Fed. It's unclear to me how much how much the increase in rates will impact the smaller banks, since the big banks are not passing on the rate increases to their depositors. And if you look at the data on retail 3 month CD, it's barely moved. It's gone 50 basis points up since the beginning of the year, since the trouble with Silicon Valley Bank, but it remains well below the yields that you can get from money market funds. And if you look at the deposit base, again, just looking at the data, nothing else.
Yeah.
If you look at the deposit base of small banks, it is stable. So there is an issue with profitability, which, in a way reflects the resolution of the GFC, was a resolution created for behemoth that will never be allowed to go under uh, because they are too big to fail. So those 4 large banks have a funding advantage relative to the smaller banks. And now that there have been some mistakes in signaling the direction of rates, um, so there has been a bit of volatility. These long-term issues created by the resolution of the crisis are becoming apparent. They are long-term issues, and that's why I see the crisis more as a simmering with the
Right.
backdrop than exploding.
But it's still there, and it's
Definitely.
still quietly building.
Definitely.
Okay. Okay. Awesome. I'll just do as we've been doing the last few months, just highlighting a few of our interesting kind of pro and now kind of Macro Hive wealth focused pieces. Henry released his PCA rate analysis piece, which now also includes expanded Spanish, Italian, and French bond curves as well. And for people who haven't seen, definitely worth checking out. The model itself has a over 70% hit ratio, which in the business is pretty good, and very rarely seeing models like that, by the way. So that's amazing work from Henry and the team. The Varesh's Oil Weekly continued to break down, especially post the OPEC announcement, certainly by Saudis with volunteering 1 million barrels per day cuts. FX carry, we're looking at another potential kind of input or signal, looking at terms of trade and how that can affect performance in FX carry. For people who don't follow FX carry, but it's in your wheelhouse somewhat, FX carry has been one of the top performing trading models all year, and definitely worth, not just in developed markets, I think maybe even more in emerging markets, absolutely worth checking out. Caroline did a very interesting piece in her kind of EM under the spotlight, looking at the basic balances and valuations across FX valuations across EM FX, with Poland and Israel looking the most attractive. That was a super interesting piece. And we continue to expand our asset allocation publication. So that's kind of for Pro and the Wealth Group. Please give any feedback on that. It's constantly trying, especially that publication, but all publications, to look to improve that and add the most value to our customers. So I don't know, any parting words, Dominique, for everyone?
As always, please. So first of all, thank you for listening. Please send feedback. Negative feedback is very helpful. And good luck, everybody.
Awesome. Okay, cool. Have a lovely weekend, everyone. Best of luck trading the markets, and obviously with the Fed coming up. And we'll be here next week. Bye.